The Fed met. Guess what? They actually cut rates. Sounds exciting, right? Cue the champagne. Are mortgage rates about to fall? Shouldn't we all be celebrating? Before we pop anything open, let's slow down and look at what the Fed actually cuts. When you hear the Fed cuts rate, the natural assumption is, woo! That means my mortgage rate's going down. But that's actually not what it means at all. Let's unpack this. They cut the Fed funds rate, and that is not the rate that you get on your mortgage. The Fed funds rate is the interest rate that banks charge each other when they lend money to one another overnight.
Bueller.
All day long, banks are lending money out, taking deposits in, sending wires, funding loans, and collecting payments. So, by the end of the day, a bank can either have extra money left or be short of its required reserves. The Fed requires banks to keep a certain amount of cash on hand so that the system doesn't collapse if financial stress hits. So, Bank A ends the day with extra money. Bank B ends up short. Bank B borrows money from Bank A through their accounts at the Federal Reserve and pays interest for that privilege. The interest rate is, you guessed it, the Fed funds rate. So, when the Fed cuts rates, it means Bank B is actually paying Bank A less interest for those overnight reserve adjustments. Okay, that's interesting. So you might think, well, if the big bank with the extra cash is making less money, wouldn't that make lending more expensive everywhere else? You know what? That's actually a really good question. That's a fair question. And here's where it gets interesting. Mortgage rates are not tied to the Fed funds rate. The Fed doesn't tell lenders what their mortgage rates should be. Banks are independent institutions. They set pricing based on bond markets, inflation expectations, risk, liquidity, global conditions. So a Fed cut does not equal lower mortgage rates. It matters indirectly, but not directly. Even though banks rarely borrow overnight that rate, it sets the benchmark for the cost of short-term money everywhere. It influences credit cards, business loans, HELOCs, commercial lending. It affects how banks view risk, and it signals monetary policy direction to markets. Markets don't price the Fed funds rate. They price expectations. So that's why mortgage rates typically react more to inflation data, economic uncertainty, treasury yields, investor sentiment, than to anything that Jerome Powell announces daily. So, now that we understand what the Fed actually did, let's talk about mortgage rates themselves. My favorite topic. Woo! Mortgage rates. Mortgage rates are driven by the bond market. Specifically, mortgage-backed securities. What's a mortgage-backed security? When you get a mortgage, your lender typically sells that loan or bundles it into mortgage-backed securities, which investors buy. And those investors want a return on their investment. And the return that they demand is what pushes mortgage rates up or down. Mortgage rates tend to move alongside the 10-year Treasury yield, plus a spread for risk. Get that money, right? Of course. So when Treasury yields go up, mortgage rates usually rise, and when yields fall, mortgage rates often soften. But again, that has nothing to do with the Fed pushing a button. Boop! It has everything to do with what investors believe will happen next. That's interesting. Cue the crystal ball, right? And that's sometimes why the Fed cuts rates and mortgage rates actually go up, because markets interpret the cut as a sign that risk or instability is ahead. So now let's talk about something important. How did we ever get to the 2 and 3% interest rates? Ooh, oh my gosh, people say, I'll buy when rates go back to 3%. Okay, so let's get real about how that even happened. Those ultra low rates weren't prosperity. They were emergency medicine. Eek. We had a global shutdown, supply chain collapse, spending dropped, liquidity evaporated. The Fed intervened heavily, buying those mortgage-backed securities to artificially push yields and rates lower so that the system didn't freeze. Investors fled to safety. Government stimulus flooded the economy, and the result was 2 and 3% interest rates. But that wasn't normal economics. That was economic triage. To go back there, we would need similar conditions: severe recession, collapse in spending, panic-induced flight to safety, and massive Fed intervention. So I don't think any of us want that to get a lower mortgage rate. Ultra low rates feel good. They feel so good. Oh, I love it. But they are not healthy long term. They crush bank margins. They hurt savers like you. They distort pricing and build bubbles. Low rates are a ventilator. Only necessary in a crisis and destructive if used long term. Historically, the rates that we have today, which is in the 5s and 6s, are extremely good. They are so good. Anyways, people bought homes and built wealth and lived full lives at 7%, 8%, 9%, even 10% or 18%. I'm sure you've heard your parents or grandparents say. Today's rates are awesome. They're sustainable, they're healthy, and they are reflective of a functioning economy, not a collapsing one. So let's talk about you. All right, so if you're paying $3,500 a month in rent, let's just pretend that rent never increases. Obviously, we know that it will, but let's just pretend that it won't. So $3,500 a month in rent times 12 months. Okay, that's $210,000 gone with nothing in return. No equity, no principal reduction, no tax advantage, asset appreciation, nothing. Okay. So now let's compare that to owning. Let's pretend that you bought a home 5 years ago. And let's also pretend that your mortgage payment was higher. Let's say $5,500 instead of $3,500. Your renter brain might immediately say, that's $2,000 more a month. I can't afford that. You're crazy. I can't afford that. But here's the kicker. If you had purchased 5 years ago, the amount of equity that you would have built is staggering. On the Central Coast, your equity gains over the last 5 years average somewhere around like $250,000. And the Bay Area, those gains are like $500,000 to $1 million at least. So even at the lowest point of those ranges, $250,000 of equity, that averages $5,000 a month in growth, in value growth. Meaning, if you sold that home today, you would walk away with roughly $250,000, which equals $5,000 per month in earnings the entire time that you were living there. Oh, that's interesting. So let's do the net math. Your mortgage payment was $5,000. Your equity earned was $5,500. Your equity earned was $5,000 per month. So that leaves a net housing cost of just $500 per month. That sounds pretty good. But you know what? Here's where it gets even better. Once you factor in mortgage interest deduction, property tax write-offs, your W-2 paycheck impact, which is less taxable income, that $500 vanishes. And homeowners wind up ahead because take-home increases too. So not only were you not losing an extra $2,000 per month like Renter Brain had assumed that you were actually growing wealth, lowering taxable income, building leverage, and positioning yourself financially, all while living in a home that you own. That is the part renters don't see because they don't want you to see it. They don't want you to see that math. So here's where you might say, oh my gosh, Tanya, but I don't want to be obligated to a home loan. Oh no, oh no. You know what? You already are. Rent. The only difference is one obligation builds wealth and the other builds your landlords. Eek. Ugh. Yeah. So let's talk about the asset piece. Let's say that you buy a 3-2 starter home, 3-bedroom, 2-bath starter home. Something unplanned happens. Job loss, health change, curveball, whatever, some kind of curveball. Here's what people did in the last recession. They walked away from homes because they thought that they couldn't afford their mortgage, or they didn't want to because, the values were coming down. But what they really couldn't afford was the massive rent increase that followed. They would have been far better off keeping their fixed payment, their tax benefits, and the stability and the roof over their head. Fast forward to today. Let's just forget about that ever happened. Let's just say something goes wrong. You still have options. You could rent your home to another family. Let them help pay your mortgage, downsize temporarily, stay with family for a bit, whatever it is that you normally would have had to do anyways. Meanwhile, your asset continues growing value and equity, and the renter you used to be is now paying your mortgage. Or, here's the more likely scenario. Life continues forward as it usually does. You grow your equity, your loan balance drops, your value increases, and when you need a larger home, you sell it. Now you've got stacks of cash, hundreds of thousands of dollars to put towards your next one, right? That does not exist for renters at all. There's no way you could catch up like that. And waiting for perfect timing just means you're putting yourself farther and farther behind those types of goals and realities. So now that you're out of renter brain and you actually understand how this works, what are you waiting for? I'm an expert loan and financial strategist. My job is incredibly important because it affects how you live, how you build wealth, and how stable your future is, and how your family is positioned, whether you're getting a loan from me or your landlord is. This affects you. You're paying a mortgage either way. And if you're waiting because you think rates are high, remember, rates in the 5s and 6s are amazing. They are so good. What are your rates for your credit cards? 30%? Oh, I'm sorry, 29.99%. How about your car loan rate? Like 6 to 14%. A personal loan rate, 12, 14, 15. Borrowing from a friend rate. A mortgage is the cheapest money that you will ever borrow, and the only money that builds wealth while you use it. Wow, that's awesome. Please like and share this information because this is the kind of financial education that they should have taught us in school. Honestly, I feel like this might have been a little bit more useful than memorizing the Magna Carta. I guess it depends. So, if this helped you, share it to someone so that they can also get clarity. And if you want to talk through this personally, call me. I'm here. It's free. We can just run numbers, look at options, and I'll give you resources to help you get prepared. You don't need to have everything figured out before you reach out. That's literally what this conversation is for. So text me, call me, WhatsApp me, and we'll start a conversation. My number is 408-710-0265. No pressure, no obligation. We may discover that now isn't the moment for you, or we may find out that this is exactly where you're supposed to be. But here's what I don't want. I don't want you hearing this same message in a year from now after you've lost more money to rent and missed out on all of that growth that you could have captured. I would much rather that this money be in your pocket. I look forward to hearing from you.